Good evening, everyone. Indo-US Chamber of Commerce of Northeast Florida welcomes you to the healthcare planning session. We are thankful to make this session especially for you. Thanks for joining. I would like to welcome Kamesh Aisola, our very own board chair member, as well as Linda D from our executive committee, who will be the moderator for this event. Please welcome Kamesh and Linda D.
Hello. Thank you, Amada. Hello. Good evening. Thank you for taking the time to joining with us. I have a special appeal. We are an Indo-US Chamber of Northeast Florida. And as most of you know, India is going through some very tough times during COVID. So I'd like to take this opportunity to request each and every one of you to make a heartfelt contribution towards the India COVID relief cause at sevausa.org. They have a mission of raising $10 million by the end of this month, and they are pretty close to about $7.5 million. It'd be really nice if you all can get together and help them reach the $10 million goal. And please have your thoughts and prayers towards India and all its people as they fight through this COVID battle. Thank you very much. Linda, please go ahead.
Thank you very much, Amuda and Kamesh. And let me add to that we are very fortunate to be sitting in this country where right now vaccines are very plentiful. Please keep that in mind and share what you can with the people in India who are not as fortunate as we are. There's a banner that's going across the bottom of your screen. It's got some information where you can log in and make a contribution. Please be generous. We all have family and friends that are back in India, and they are just in a panic. All right, ladies and gentlemen, I have had the pleasure of meeting a gentleman through the Indo-US Chamber who will be speaking to us tonight. He is a charming man with a very diverse background. In fact, his education is in engineering, and then he pivoted, as they say, into a completely different field with his education and taking it into education and then into financial advising. Ladies and gentlemen, tonight, Janak Desai, who is an independent financial advisor, will help us to demystify some of the things that are very important to us. If COVID has taught us nothing at all, it has told us how very important healthcare is to our lives right now. It's essential that we have all of that in order because, as we've learned, who knows when the next calamity will be around the corner. And I don't know about you, but I have enough trouble learning and understanding what my 401k is. So, ladies and gentlemen, I would like you to get your questions ready. Got your pens handy? And get your questions ready because Mr. Desai will be talking to us about health savings accounts, how they can help us now and how they can help us when we get into retirement. Ladies and gentlemen, my pleasure to introduce Janak Desai.
Hello, everyone. Thank you, Linda. Thank you, Kamesh. Thank you, Amuda. I appreciate that. And I second and concur with what Amuda, Kamesh, and Linda said about seva.org. As Linda mentioned, we all have connections one way or the other in India, and we should support us being in the lucky seat sitting here and vaccinated. With that, further, I'm going to start sharing my screen and we're going to talk about health savings accounts. And oh, come on. Sorry, guys. I lost that whole screen.
That's okay. Be nice to the technology. It's our friend.
I'll try. Okay.
Yes, I know your expertise is in financial advising. There we go.
There we are. There we are.
And go into presentation mode, please.
Okay. So main thing, like Linda mentioned, is like healthcare cost, not now only in retirement. One of the big thing is that Employee Benefit Research Institute shows that couples in retirement at age 65 will need $363,000 in 2019, assuming 90% of chances of having enough money that will last through their retirement into to take care of their healthcare cost needs. And this is for the couple. If you're in the 90%, sorry.
Please go into presentation mode. You're not in presentation mode.
Oh, I'm not. Okay. It shows that it's sharing.
No. You're sharing, but you're not in presentation mode.
Okay. Let's see what.
At the bottom right, you see right there, that icon.
Okay. Do you see it now?
No, we still see the chat window on the right side.
Okay, wait, hold on. Let me see if I can.
The top, it says start slideshow.
Oh, you seeing that? Okay, that is.
You're probably looking at the wrong screen.
Do we want Amuda to handle the slides?
Amuda? I thought the dry run just went very well 2 minutes ago. So
yeah, that's right. Yeah. Is it?
Okay.
Can you see it now?
Yes. Well,
Okay.
we are seeing the different screen, but
do you see the?
Go ahead. This is good.
This is good. Okay. Like I said earlier, that Employee Benefits Research Institute estimated that some couples could need as much as $363,000 at 65 in 2019, assuming 90% chance of having enough savings. Okay, 50% chance that they'll need 163K. So with that, and as we all know that the healthcare costs are rising, and 8% predicted cumulative increase in total employee costs from 18 to 20. So if you look at the bar chart, in 2001, it was 8414, and right now, 2020, they are expecting average annual healthcare cost of 28,653. Okay, that is 7.7 predicted increase in total employer cost from that time. Now, this is just the employer cost. Now, what are the concerns? Keeping those numbers in mind, what are the concerns about in retirement? When the survey was done, 75% said that, say, one of their top concerns is healthcare cost. So healthcare is in everybody's mind, whether they are currently working or they're getting towards retirement or if they are retired, okay? 67% said that do not feel knowledge about how much they will need to cover healthcare costs in retirement. And that's why those figures were necessary to give an idea that, okay, what the cost will be. And 39% said would take money out of their 401k plan to cover those unexpected healthcare expenses. 43% said would take money out of their regular investments, non-retirement accounts, and pay for it. Now, what is HSA? HSA is a health savings account, okay? Do not confuse with FSA. FSA is flexible spending account, which is a lot of you folks are aware of it that have used that, is use it or lose it. Here, it is not use it or lose it. If you don't use it, it carries forward and goes on. One of the advantage is it's got a triple tax advantage for qualified medical expenses. And we're going to cover that a little bit further down, how it's triple tax, okay? One of the things is compared to, Linda mentioned 401k, opposed to 401k, here there is no income minimum limits for IRA and Roth IRAs. You have income limits. Here there are no income limits. There is no phase outs. A person earning $100,000 can put the same amount into HSA. Person earning $1 million can put the same amount in their HSA. So it's not phased out. And this is in addition to 402G and 451C, which are other health benefits planned through the government organization. Just like 401k, once you reach age 72, now I know a lot of them are taken back that, okay, why 72? up till now, we have heard age 70. 70 was changed in 2019 when the new Secure Act law was passed, where the required minimum distribution age was changed from 70 to 72. Okay. When the distribution from the qualified medical expenses they are not included in modified adjusted gross income, which a lot of time for taxation purposes on Social Security that you receive. And that's another topic which takes another hour. We're not going to get into it, but just to give you a general idea, what they mean by modified adjusted gross income is where those benefits are added to the income, like Roth for calculation on taxation. Decrease employer and employee income and payroll taxes. So when it's offered through an employer, so anybody that owns a small business, it's a perfect thing to offer because they will save on FICA of their portion. So employee saves their FICA portion and employer saves their FICA portion. That is 15.3%. Okay. And it allows for employer to contribute into it. I know in 401k also it contributes. Later on, we'll see how it is advantageous to have both from the employer and employee's perspective. So to qualify for HSA, what are the requirements? Okay. First and foremost, it has to be high deductible health plan. Later on, we are going to show you the dollar amount that is needed, what is defined by IRS as high deductible health plan. Another thing is that you cannot be covered by spouses or other person non-high deductible health plan, okay? Remember, non-high deductible health plan. So other coverage you cannot have in addition to this to qualify. Okay, so you have if you have that, it disqualifies you basically, and including spouse or other person's general health flexible spending account. So general, there's two types of flexible spending accounts: general and sort of defined, nor health reimbursement account. Okay, so if you have those, it disqualifies you. Just keep those things in mind. And you are not claimed as a dependent on other person's tax return. So a lot of time I have run into this where husband and wife, they have a child is working part-time and they are dependent, okay? And they are covered under their plan, or child might have high deductible plan through other places, but they're claiming as a dependent. That child cannot open up a HSA. Anybody that is in Medicare does not qualify. So like I mentioned earlier, what are the limits, okay? So as an individual, so somebody that just does by themselves, so somebody single, okay? Your child that is in full workforce, not married, their contribution for 2021 is $3,600. Kamesh, can you see the cursor when I'm putting it there? Okay. But for family is husband and wife is considered family. Family is considered husband, wife, and any dependents that they are claiming on their tax return. They can put up to $7,200 total. Now, in addition to that, if you are individual or family, you can do an additional contribution of $1,000 if you are 55 and older. The catch-up contribution in 401k, it's 50 and older. Here it's 55 and older. Now, if the spouse wants to contribute to their HSA and do a catch-up contribution because they are covered under family plan and they are 55, they have to have a separate account, and that's where they can contribute that additional catch-up contribution. I mentioned earlier about deductibility, what they define as high deductible health plan. So if it's an individual account, $1,400 is, if the deductibles are $1,400, it's considered high deductible. If it's a family plan, Family coverage, it's $2,800 deductible. And then on top of it, the out-of-pocket expense, individual, $7,000 is the maximum out-of-pocket expense. Family is $14,000 out-of-pocket maximum, which is defined by the health plan, okay? So, but the main thing to keep in mind is the $1,400 and $2,800 pretty much qualifies you to open up an account. So, in HSA, how it is triple tax benefit. The money that goes in, the $7,100 or $3,500 or $3,600 for 2021, you put it in, is you're not paying taxes on it, okay? Then the money that is there, when it's invested and it grows tax deferred. And the reason I'm saying tax deferred and not tax free, in a minute, I'll explain that also. But if you have any HSA qualified medical expenses, it's 100% tax free. And here is the list: acupuncture, chiropractor, COBRA coverage, because if you get laid off and if you have a HSA account and you need to pay for COBRA premiums, this is where you can pay from. For somebody that is retired, their Medicare deductibles can be paid from there. Their premiums and out-of-pocket can be paid from HSA, okay? Eye exams, lab fees. Another one is long-term care premiums can be paid from HSA. And there are limits. We're going to cover that in a minute also, where it tells you age and how much. So like I explained earlier, it's triple tax free. So deposit, it can be anybody, employer, employee, or family. Keeping in mind, if it's a family plan, $7,200 for 2021, $3,600 for an individual, okay? Now, one of the things that I have run into a lot of time is these HSA plans are set up, but they do not know that you can invest. Yes, you can invest and let it grow. It's entirely up to you, or you can use your advisor and see how you can invest it and then withdraw it for qualified medical expenses. And then other purposes, age 65 plus, we're going to cover that also in a minute. But I hope that is making clear that expense-wise, any medical expenses can be paid by HSA.
Before you move on, Janik, we have a question from the audience.
Sure.
Can you see it run across the banner? It says if only high deductible health insurance, but if not, saying HSA qualified, can you still put money in HSA account?
That's correct. If the employer, if the health insurance is through employer, and if it says that it's not HSA qualified, then probably the individual limit and that they are meeting, but they are not meeting the out-of-pocket maximum, they're not meeting. It has to be HSA qualified. I hope that's clear. So
yeah, so for the person who asked that question, if it is not clear, can you send us out another question? And while we're waiting for that, Janik, go ahead.
Yeah, and here's the thing: out-of-pocket, high deductible health plan. Okay, so individual out-of-pocket is $7,000. Okay, maximum out-of-pocket, and family is $14,000 out-of-pocket maximum. So those are the figures that, and in a minute I'll give IRS publication where they can look it up and see. Okay, all this.
Okay.
So as far as the distribution, means basically money that is sitting in HSA. Okay, all distribution pre-age 65, not used for qualified medical expenses, there's a tax penalty. Just like when you take out money from 401k prior to age 15 and a half, same thing. You get 10% penalty plus the taxes. If there is an excess contribution for whatever reason, before you file your taxes, you can remove it, okay, and not pay penalty and taxes. The second tier is taxable, but it's no penalty, okay? So all distribution post age 65 means before age 65, not used for qualified medical expenses, okay? Sorry, past age 65, after age 65, when you're not using it for qualified medical expenses, but you just take it out. And I'm going to show you a trick in a few minutes, how you can, if there is a need, how you can use it, okay?
Okay.
Disability distribution, okay? So for disability, if you take it out, death distribution to the beneficiary, and I'm going to clarify that in a few minutes also, because there are different ways which beneficiary it's taxable and which beneficiary it's not taxable, okay? When is it 100% tax-free, okay? Means qualified medical expenses, the list that we looked earlier, premiums during unemployment, so COBRA, okay? Or if you're not on COBRA and you buy your individual coverage through different sources and the premiums that you're paying, you can pay from HSA. Long-term care insurance premium, okay? And then it says up to applicable limits, which we're going to cover in a minute. Medicare premiums, okay? Deductibles that you have to pay and co-payments, okay? Rollovers and transfers means rollover from, let's say you at an employment, you have your HSA. Now you have changed employment or retired, you can roll it over. Or while you're there at your employment, you have HSA, but some of the HSA banks do not allow investment options. You can do a transfer while you're working, contributing to that HSA. So your employer contribution, you're taking advantage of, which I'm going to cover in a minute, and your contribution, so you're not paying taxes on it. You're saving that 15 point, your FICA deductions, okay? So you're not paying FICA on it. And then you can take it and transfer it to your own HSA account. You can do that. There is no limit how many HSA accounts you can have. Normally, I have seen 2 to 3, one for spouse, one for each husband and wife, and then one through work. So normally, whoever has got a better health plan with the HSA benefit in it, they're enrolled in it, they take the advantage of it. So that's how the 3 accounts.
Okay, great. I think we have another question. Are you ready?
Sure. Yeah, I am ready.
I think it's the same person. Can you read it, or would you like me to read it?
Please read it. Linda, I can't see those questions.
Okay. As a self-employed, if I have health insurance with deductibles more than $1,400, but no HSA qualified, can you have an HSA account and put money?
Correct. So if it's got a high deductible plan, it's as long as the health insurance company says it's a high deductible plan. And normally I always ask, whenever I'm opening up a HSA account, bring the health policy document so we can look at it and make sure the qualifying status are there. They can go ahead and open it up. Yes.
But in this case, Janak, in this case, the caller is saying it is not a qualified HSA account. He only meets the 1,400.
Okay. No, if it's not qualified HSA account, you cannot. And that's why sometimes, even though they say non-qualified, but if they're meeting those criteria of 1,400 as an individual and the family deductible of $9,000, a lot of time, even though they say that it doesn't qualify, bring your health document, we can look at it and we can get it answered. Because, and he's right, because there are a couple of cases that we had to call the carrier, or we look at the IRS publication, which I'm going to give which publication it is, and look at it, that does it qualify or not.
Great. Thanks, Janak.
Yeah,
Okay.
so it sounds like it's good to have someone like you who is an expert just to take a look at it.
And to that point, Linda, and that's why like 401k, okay, everybody understands, but there are so many things that are associated with 401k is rather to have an advisor that is looking at it and guiding you while you're in the building phase, let's put it that way.
Okay.
So where we are talking about tax treatment. So let's look at it. The most common tax deferred or tax free accounts are 401k IRA, 401k, or your IRA if it's a self-employed TO plan, SEP plan, all those things. So the money that you put in, you're not paying taxes on it. But when you take it out, it is taxable event. So at that time, whatever tax bracket and rate is, you'll be taxed. And the required minimum distribution. What RMD is that if this retirement account, you haven't used the money and you're not taking out certain dollar amount every year, right. What IRS says is it's a retirement account, so you should be taking out, whether you want it or not, you have to take out that minimum amount, and there's a formula for it. Okay, it's based on age and calculation. So that's called RMD, required minimum distribution. Roth is another popular one. So what happens? The money that goes into Roth is after tax. You have paid the taxes on it, then you put it into Roth. It grows tax deferred. So 401k, IRA, and Roth, the money grows tax deferred, and it comes out 100% tax free. Keep in mind, only thing is that 401k and IRA, you can take money out without penalty prior, only after age 59 and a half. If you do it prior to that, there's 10% penalty. But Roth doesn't have RMD.
Right.
So now let's look at HSA. HSA money you put in, just like it's 100% tax-free. 401k you paying pre-tax, Roth you paying after tax, but this is like a pre-tax, okay?
Yeah.
Even though it says tax-free, same thing, pre-tax, tax-free, it's the same thing. The reason partly they say tax-free because the FICA is also on this. Okay. Goes into HSA. Now, if you use it for any healthcare needs, okay, doesn't matter what age. So like 401k, it's not limited to 15 and a half. It's tax-free. So that's why a lot of time I advise, especially, so let's talk about different age groups. Say a 25-year-old to 25 to, I would say 40, 45, okay? Pretty much, you are in pretty decent health. You are in pretty good health. At that time, I say, do a budgeting for yourself. And I hope everybody on this call is doing a budget that you have. In that, bake in a dollar amount that you're going to use for health. Whether you use it or not, keep it in there. So let's say, for an example, on an average, I have seen between 2,000 to 3,000 annual sort of savings that is there dedicated to use for health. So like to pay the co-pays, some prescription. If you have young kids, sometimes they break arm, that sort of thing. Or sometimes a lot of them do it for kids, what do you call it?
Braces.
Yeah, dental needs.
Braces. Thank you, Linda. Yeah, braces.
Glasses, yeah.
Yeah, so things like that, you do that. The reason being is because the money that is sitting in HSA, if it's invested in the market, it has got enough time to grow. If you put it in and take it out, yes, you're taking a little bit of tax advantage. And later on in the presentation, you folks will see how that can help, okay? So that's the tax-free. If it's taxed, it's for non-health care. So suddenly, family emergency, God forbid something happens and everything, and you need dollar amount and HSA has got decent amount sitting in there and you want to withdraw it, you can do that. If it's prior to age 65, penalty and tax. After age 65, only taxes. Okay, from the clarification perspective.
Okay.
So, how it can be used for legacy planning? Okay.
Just a second, Janak. Janak, just a second. You covered from age 25 to 40. Why did you please talk about 45 to 55 and beyond? How can
and it's coming here, Kamesh.
Okay, all right.
Okay. So HSA is like a trust account, okay? So the account holder should name beneficiary. Remember, in 401k by default, it goes to the spouse.
Mm-hmm.
Assets in the trust, it bypasses the probate, okay? And it's directed to the named beneficiary.
Okay.
So life insurance, it's the same thing. If you have a named beneficiary, it bypasses the trust and sort of a probate. It goes to the named beneficiary. Annuity, same thing. So similar to that, these are trust accounts, okay?
Okay.
Now, with beneficiary designation, the spousal beneficiary, if you name your spouse as a beneficiary, it's treated your spouse SHA upon your death. So automatically it becomes her or his account, okay? And that's why in parentheses it says, unlike a qualified plan, there is no legal presumption. So there is no presumption, okay, in favor of a spouse as a default beneficiary. You have to name. So HSA is critical beneficiary designation. So now let's fast forward. The surviving spouse passes away and still there is money sitting in the account and it goes to the child or mainly the child, okay? Then that becomes non-spousal beneficiary and it's a taxable event for that child.
Okay.
So that is the reason that, okay, you have to be careful in the planning process, and that's why you need somebody, an advisor with you to plan these things in the process, because you do not take out too much money, you do not leave too much money in there and do a proper planning, okay? Without beneficiary designation, whether your spouse gets it or your child gets it or whoever gets that money, it's a taxable event for them. It's included in the year they inherited. That's the year it becomes a taxable event.
Okay.
Okay.
Okay. Mm-hmm.
Now, one thing I have to put out there, a disclaimer. I am not a tax attorney or a CPA. I do not give tax advice, okay? And always, these are the tax laws that are there, okay? But in a lot of situations, these tax questions can be answered by your CPA or your tax lawyer, okay, if you have one. Because federal laws and state laws are complicated, different states. Florida is a lucky state. We don't have state income tax, but I do have clients that are not from Florida, and the laws are a little bit different, okay? And that's why I have to put the disclaimer that I'm not a CPA or a tax accountant, a tax lawyer.
Thank you.
Okay, so going forward, okay, what happened? It's stuck.
Yes, thank
you.
you.
Wait, hold on. Let me go back. Oh, why it stopped?
Amuda, can you go back a slide?
Okay, wait, hold on. Linda, let me see if I can go through and.
Janak.
Yeah.
Amuda is sharing the slides. You're not controlling the slides.
Oh, okay. So are we at the saving efficiency?
We are at legacy planning still.
Oh, okay. Next slide, please.
Yeah, saving efficiency. That's where we are. Saving.
That's it.
Yeah.
Okay.
Thank you, Amuda.
Thanks, Amuda. Okay. So this is for a couple who utilizes the triple tax-free characteristic. So I've used here two different tax bracket, 24% tax bracket and 35% tax bracket. Kamesh, I have not forgotten your question. I'm going to come to that in a minute.
I won't let you get off. I won't let you get off without the question, so no worries.
So 24% tax bracket, okay? So if they both 24% and 35%, they have saved $399,000 into their HSA.
Mm-hmm.
But let's just say that they do not have HSA and they try to use 401k just to cover the cost of that $399.
Mm-hmm.
If you're in 24% tax bracket, 401k has to be $525,000. So the equivalent of $399 in 24% tax bracket is $525. For 35% tax bracket is $613. So just by having HSA, you saving $126,000 for 24% tax bracket, and 35% you're saving $214, because both of them you're not paying taxes on. Okay, that's why.
That adds up, doesn't it?
Yeah, it penny makes a dollar, dollar makes 10, and 20, and then 100. That's
got it.
That's what I sort of tell my clients. Okay, Amula, next slide, please. Okay, are we there?
Yeah, HSA
yes.
maximization. Okay,
Mm-hmm.
This is where I'm going to cover. So let's start with somebody that's 25-year-old, enroll in a single high deductible savings plan and start putting money into it. So after 10 years, at age 35, they'll have $57,508.
Mm-hmm.
Then they are settled in life, get married, and have a family, okay? And have a family coverage of high deductible health plan. So obviously it becomes a family plan. That becomes at age 55, because they still have that, and 55 and older, they're doing a catch-up contribution of that $1,000 each. So after 30 years, at age 55, so from 25 to 55, they are sitting at $534,000. So at 65, and a lot of people, the full retirement age is 67, but at 65, you go into enroll into Medicare program, okay, Part A and B, and you have premiums for it. Where do you pay it from? At 65, you have $1.19 million saved up. That is at retirement, okay? Mm-hmm. And this is person with the high tax bracket we are showing, okay? And where they're maximizing their contribution. Average rate of return of only 6%, okay? We are not shooting anything, the pie in the sky, so to speak, okay? So it's close to $1.19 million, because miracle of compounding also comes into play if you're not taking money out of it. So this is without withdrawals, okay?
Sure.
Saying that. So now let's talk about age 40 and above. What happens? Normally, a lot of them are falling into it. So if you look at it in 30 years, you still have that $500,000, okay, mm-hmm. that you have accumulated. So 25 years, so between $500,000 and $400,000, you're going to accumulate from 40 to your full retirement age 65. Normally, a lot of time, people that are in their 50s also start that, okay? Still, it's a decent amount. It comes to close to $250,000 to $300,000, depends. Like I said, we have to look at their health condition also, because if, God forbid, and they have major health issues, then they need funds from the HSA, then there is no growth in it, okay? Only thing they're taking advantage is that tax deductibility.
Yeah.
Taxes, the tax deductibility. So that is the big plus for that. 60 to 65, yes, if you look at it, let's just say on an average $7,200 plus their catch-up contribution of $2, so close to $9,000. Okay, so still it is good amount of money. Now, if they're in a decent health, and if we can push it to their full retirement age of 67, normally what happens is person retires at 67. Till then, they are covered and they are working. Okay, so a lot of it, like I said, the budget that they have set aside for health normally covers it, unless and until some major catastrophe comes and they need funds, it's always available. But if they can leave it there, then they have got enough time to grow. Okay.
Yeah.
I hope I'm answering your question, Kamesh, that you had mainly, that, okay, different age group.
Yeah, makes sense. So it's just like 401k, the sooner you start, the better compounding you have. The later you start, you're losing advantage of time. But it's always better late than never, is what you would say, right? I mean, there's
That's
no time like right now. I have one question, Janak. Sure. Would you invest in the HSA 401k before you even maximize your regular 401k? Or would you say, no, let's take advantage of that? Both are different vehicles. How would you advise somebody who has to make a choice?
Okay, so that's where the age comes into play, Kamesh, okay? If I'm talking to a 25-year-old, okay, the question that I ask is that, okay, look at what do you think currently, are we in the highest tax rate environment, low tax rate environment, or median tax rate environment? Okay, then you don't have to answer it. Fast forward yourself, okay? 25-year-old, 40-year-old, or even 50-year-old. So sure. 15 years, 25 years, or 45 years. Mm-hmm. Down the road, do you see the taxes, your tax rate or taxes, going to stay the same, going to increase, or going to decrease?
Okay, got it.
So depending on that, so let's answer in the order. 25-year-old, I just tell them that, okay, if you can do both, maximize your 401k and your HSA, do it.
Okay.
If you cannot, then let's look at your 401k and see. Then HSA, you definitely want to start putting money in there.
Okay.
And I'm going to show how you can take out later on in life without any taxes, 100% tax free.
Okay.
I have a question for you, Janak.
Sure.
Is there a minimum amount? We're talking about somebody who's just out of college, may have college debt. You're suggesting that if they can afford at all to do both, do both. Well, certainly if an employer is matching, you want to be able to put in some into a 401k and at least take advantage of the match. Is there a minimum amount? Would $5 a week, $10 a week?
Anything up to $7,100. Okay. Individual is $3,600.
Okay.
So maybe give up a Starbucks latte every week and put the money into an HSA.
You read my mind. That's when the budgeting, we sit down and look at the budget that, okay, where are we going to find to fund HSA?
Yeah.
And that's when we sit down. When I sit down with my clients, we look at it that, okay, first thing I ask is for budget. Give me your budget. If you don't have it, make one, and then let's sit and talk about it. Budget is very critical for this thing, for planning process, okay? And then, yes, but if they don't have a budget and they say, oh, I can put $5 or $10, whatever amount they say, we go ahead and set up a HSA.
Okay.
Now, one of the big advantages through employer, if they are offering, they are putting money in HSA plan. You don't have to be enrolled in it. Employer contributes towards your HSA if you're in a high deductible health plan qualifying for HSA.
Okay.
So, Linda, to answer your question, whether they should enroll in that high deductible plan when they are in young age, because probabilities of them needing health benefits are
Right.
less, except annual checkups and those sort of things. So at least they can take advantage of employer contribution.
Okay.
Very
Now,
good
what
point. Very good
Let's
point,
just
because
say-
people, we normally shy away from high deductible health plans. Now you are giving us a very compelling reason to move towards that, depending on the individual and family's health. Thank you.
And that's where, Kamesh, we sit down and do a math that, okay, how much premium amount you're going to save by going into regular PPO plan or into a high deductible plan, okay, just for an example.
Yeah.
Let's look at your last year total medical expenses.
Mm-hmm.
Now, a lot of time, well, at least in Florida, we are advantageous because Florida Blue, whoever is enrolled with them, they have their year-end
Statement. Yep.
statement with year-to-date expenditure. So we know what they're spending in health, whether it was paid from their pocket or, well, 99% is from their pocket because these are deductibles. And we do a comparison, let's put it that way. And that is always, so far, 95% of the time, we have found a way where it fits in their budget to do a high deductible plan and do the HSA.
Okay.
And not costing too much out of pocket. Now, it's health we're talking about, so we don't know what's going to happen tomorrow, okay? So that's why I said, don't hold me to it for one reason, because we might do this plan and next thing, some catastrophe happens and your high deductible plan, you have to pay that $9,000 out of pocket, then it's covered. So those are the things that when I'm talking to the client is that they have a clear understanding before they make a decision.
Sounds good.
Sounds good?
Thank you, Janab.
Okay, not a problem. Okay, how about the next slide? Okay.
It's a long-term care insurance. Yeah, you're there.
Okay. So like I said, long-term care insurance, what is deductible, okay? Premium-wise, okay? So if you are HSA qualified and you have a long-term care, anybody under age of 40 can deduct $450 premium, okay? Annual, because I know that question has been asked that, okay, annual or, and this is where, can everybody see the IRS website publication 502?
Yeah, 502.
You might want to send it to everybody to see, which is the IRS Gov Pub IRS publication 502.
Yeah, Amuda will put it on the banner. Amuda will put it on the banner.
Yeah, put it on the banner, because that way, that's where they can go. And because folks, if you can go and look at it. If not, we'll talk about it later, how you can get more information on it.
Yeah. Okay.
So age 71 plus, 5640, $850 for 41 to 50, so on and so forth, the different age bracket, okay? So this is where, if the money is sitting, so somebody that they see that, okay, we need money from age 50 to 60. Remember I said budget and the money that you're paying from out of your pocket.
Mm-hmm.
Okay? Here is an example that, okay, you can do retroactive. So between age 50 and 60, Jim and Stacy contribute the maximum allowed each year into Jim's HSA.
Okay, next slide, please.
No, wait, hold on. Oh, are you at the retroactive?
Yeah,
No,
we need to get
yet.
to.
Oh,
Yeah,
sorry,
we are there
sorry.
now. We're
That's
there.
it.
We're there.
Okay, so this is what I was talking about, how you can take advantage of accumulating that money and you don't need it, but you want to just use it for whatever reason. So this is one of the exception, and that's why that IRS publication clarifies it. So this is for the illustration purpose only, okay? So as their 40th wedding anniversary Jim and Stacy wants to go on a vacation and they need some funds, say $15,000, okay? But from age 50 to 60, they have qualified medical expenses, out of pocket, deductibles, co-pays, they got their glasses done, their
Knee replacement,
work,
whatever.
Yeah, a denture, so on and so forth. And they have those receipts. As long as you have those receipts, you can withdraw funds from it without, those are non-medical expense, non-medical use. You can use the funds and use it wherever, as long as you have to keep the records of it, okay? Because if IRS audits or ask questions, you should be able to produce that, okay, you had this legit expenses. But that's one way off, because I know a lot of time the question that I get from a lot of my clients is, hey, yes, this is all well and good. What if my wife and we just see that, okay, we're not going to need so much money, or we have done enough planning, and where apart from HSA, we have covered. So if there's nothing in HSA, we can cover our medical expenses, okay? So for somebody like that, we can do that, okay, you can use it, okay?
I see that we've posted the government, that information you had indicated, Janek.
Yep.
Yeah, there it is.
There it is. There it is. Thank you.
Okay. Amuda, next slide, please.
This is the last slide. Yeah.
Yeah, this is the alternative contribution model.
Okay, so Linda, to answer your question earlier, okay, let's just say somebody making $65,000, okay, they're putting 10% into their 401k.
Mm-hmm.
Employer is matching 1,950, correct?
Yes.
So the total tax they're not paying taxes on is 8,450.
Okay.
We just take their 401k and reduce it to 3,900. That is to the match, okay? Because they're matching 50 cents to a dollar up to 6%. So you put in 6%, they're matching 3%. Okay, so we drop it down to 3,900. 1,950 is the match.
Yeah.
They go ahead and put employee HSA contribution of $2,600.
Okay.
And the employer matches that $1,000.
Very nice.
Very nice.
Okay. So that is $9,450 addition without
a penny from the pocket.
Penny from the pocket, and they have less taxes.
Yeah.
Okay. So, okay.
It's very nice.
Okay. Next, and okay.
That was the last slide. Hey, Janek, if somebody wants to consult with you.
Okay. What I'm going to offer everybody on this call that's there can give me a call, set up an appointment. Amuda, you can go ahead and put my email address. Best is if they can send me an email, and I will respond as soon as I get it within 24 hours. Call you, put your phone number in there, and we will set up an appointment for first free or complimentary consultation. Let's put it that way.
Okay. Thank you, because I think that I know for myself, a lot was explained to me. A lot of things were very eye-opening, things I wish I knew about 20 years ago, but some of it is still very confusing to me. So to be able to sit down with somebody with the pencil and paper and like you said, a budget is a very important thing. That's a very generous offer, Jenny.
Because main thing with HSA, it's not a different component. It sort of goes hand in hand for retirement planning.
Right.
And that is the thing that I emphasize that, okay, so when we look at HSA, we even look at their retirement accounts. That is one of the things, because everything should go hand in hand. Otherwise, sometimes you're putting a cart before the horse and you're hurting yourself, long and short of it. But HSA is one component. If you don't have anything, should do HSA.
Okay, that sounds very good, because as we all know, time moves fast, and before you know it, you start getting that gray hair here and you wonder where time is gone.
True.
Are there any other questions from the audience before we wrap it up? Thank you, Mr. Janak Desai, for a wonderful session, and appreciate Indo-US Chamber for organizing such a relevant session. Well, thank you. We could give you a round of applause.
Yeah.
Okay,
thanks, bye.
Here, and can you have separate insurance for each family member depending on individual's need and still qualify for family HSA deductions?
Remember, one thing is, if you have high deductible health plan, and you should be covered by it. So if you set up a family plan, you cannot have a separate account, but husband and wife both can open up a separate HSA account under that same health insurance and have 3,600. If you look at the math, it's 3,600, 3,600, 7,200, the limit, annual limit contribution. So Sonal, hopefully I'm answering your question. You can. Only qualifying factor is it has to be high deductible health plan coverage. So husband and wife, if both of them are opening up a separate account, there is nothing against it, but both of them has to be covered. It could be under one plan. So let's say through husband's work or through wife's work, they are covered, because I'm covered through my wife, okay, under high deductible plan.
Okay, so it sounds like Sonal needs to get your email address and maybe set up that complimentary consultation and get all of the questions answered at once.
And the email address is on the banner right down. Email address is at the bottom right now on the screen.
Oh, okay, terrific. And we are rapidly approaching the 7:30 mark when we will end for tonight. But before we end, we've spoken very, very deeply about a very important topic. And I want to thank you so much, Janak, for taking the time out tonight. And I want to make one more plea to everyone. If they would consider taking a few dollars, thinking about the people in India right now this is where we were a year ago. We were suffering and there seemed to be no way out. We have a way out now. Let's help our friends, our family in India. And yes, I see Amuda has put the website, yes, down at the bottom where you can make your donation. Kamesh, anything you'd like to say on that?
No, you said it. Seva USA, you can check out. They are they are a very prominent and certified nonprofit organization. And please, they have a goal of $10 million by the end of this month. They are around $7.5 million right now. Let's help them to see if we can all work together to meet that goal. So thank you very much. And Janak, thank you very much for your time this evening. It was a very interesting topic. And thank you for taking time. And I'm really glad you're offering the very generous gift of a free initial consultation.
Yes,
no, I'm glad to do it. And I'm glad that Indo-US Chamber decided to do this, because this is a very important topic for all age groups, starting from 25 all the way to 65. It's critical and it's needed.
Yeah.
Sure. Didn't we all find that out this last year?
Absolutely.
Yes. And right. And give up your Starbucks. Come on, give up that latte, that mocha, whatever it is that you do, and send that money to Siwa. Thank you, everyone.
Thank you.
Thank you.
Thanks, Janak. Thanks, Kamesh. Thanks, Linda, for joining for this event and providing us a great insight. So now we know how important the HSA contribution is very critical for us. I also want to thank people who joined the event and also who will be viewing this recording later. if you have any follow-up questions, feel free to reach out to Janak. We have also put their contact in this recording. Please contact. And I would also like to thank my leadership team, both the board members and the executive committee who work in the back end just to put the event for our members and business owners and for all the professionals so they gain advantage during this COVID situation. So we are trying our best to provide online events. So you are still connected. So we will do our best to provide other events as well, what you are interested in. I would also like to introduce our president-elect. Let me add her back to the stream. So Richa here. She is our president-elect. She will take over next month. I wish you all the very best. So I would like, if you have some words, please feel free to share.
Oh, thank you, Amuda. Thank you so much. I really wanted to say thank you to all the board members, current board members, ex-board members, current EC members, and ex-EC members for trusting me. And I promise that my team and I will work hard to help this organization grow. So thank you so much.
Thank you. We have no doubt.
Thank you.
Good luck, Richa.
Thank you. Thank you.
All right. Thanks, everyone, for joining. We will see you in the next event soon. Follow us on Facebook and Instagram and reach out to us. Thanks all.
Good night.
Thank you.
Good night.
Good night.